So we are going to start now the cost behavior, organizational costing, and profit analysis, which is chapter 5 in your book. Managerial accounting focuses on data that is at all levels of the organization. So, for example, the business, the departments, individual services, and individual patients. Managerial accounting develops info at all levels of the organization, which makes it helpful for managers, and it is helpful for managers to for them to get insights on future planning. Um, all of this requires a lot of information, which is created by the business's managerial accounting system. And so we are going to cover the managerial accounting by examining organizational costing and profit or CVP analysis. Managerial accounting really meets the needs of managers because they can focus on managerial accounting itself. So far, we have been doing financial accounting for the most part, and now we are starting on managerial accounting because they have many responsibilities. They need to do planning, budgeting, and like I said, forecasting and future planning, as well as looking at the routine operations. So here are some differences between managerial accounting and financial accounting. Financial accounting uses organizational data, so aggregate data. Remember the financial statements that we looked at. It is designed for use by external parties. We prepare the financial statements in adherence with the uh, GAAP principles so that it can be looked at by other parties for auditing purposes and so forth. Primarily historical, because we are using data for current year and previous years, and like I said, it must adhere to the standards of GAAP accounting principles. Managerial accounting uses organizational and subunit data, and it is mainly designed for use by the managers. Um, it is primarily looking forward, and we are planning for the future, like I said in the last slide, that we are forecasting and planning for the future because managerial accounting focuses on data at all levels of the organization: the business, departments, individual services, and individual patients. It does not adhere to any standards, external standards. It is mainly for internal use. So that is the difference between managerial accounting and financial accounting. The other thing about managerial accounting is that cost accounting is a subset of managerial accounting. And when we think about cost, we are looking at cost as a resource that is used for providing a specific service. So when you use a resource to provide a specific service, there is a cost associated with it, and that is the definition of cost. There is two types of cost: um, fixed cost and variable cost. Fixed cost is certain and it is not related with volume, whereas variable cost is related with volume. Um, so let's look at cost measurement for a bit. For healthcare providers, a cost is typically one that is a resource used for providing services or supporting any specific service. Cost accounting is a subset of managerial accounting, and managers are concerned with what is going to happen in the future rather than in the past. So, cost accounting, cost measurement is an entire field which is a bit different from financial accounting, and there is no single definition for the term cost. So, different costs are used for different purposes. Costs are classified in several ways, and we will look at the relationship of cost to volume of services provided. So, is there a difference between a cost and an expense? So, cost accounting systems are used to develop the expense data that is reported on business's income statement. Therefore, cost accounting bridges managerial and financial accounting. So, even though cost accounting is a little bit of a subset of managerial accounting, it is kind of a bridge or a linkage between financial accounting and cost accounting because cost accounting systems they can help in developing the expense data that is reported on the business's income statement. So I was telling you earlier that there are two types of cost: fixed cost versus variable cost. Um, the two types of costs are based on activity, utilization, and volume. How much patient service activities are you doing? How much are your patients utilizing your services? And how many patients are you getting in terms of volume? Like, are you getting 100 patients every month, or are you getting 10,000 patients every month? All of those matter in defining fixed and variable cost. So the underlying cost structure is basically the relationship between cost and volume of services provided. And if we know that as managers, we can forecast cost at different levels of patient volume. So fixed costs are definitely keep in mind that they are independent of volume. If volume remains in certain relevant range, and we know volume for certain, then it is independent of volume. Variable cost is dependent on volume. And then we have the semi-fixed cost, which is partially dependent on volume, so a little bit dependent on volume, but then not so dependent on volume. So that's why it's called semi-fixed. In the long run, all costs are variable, and hence these cost classifications hold only in the short run, so only for 1 year. So if you think about the long run, all costs are variable. So when we look at variable cost is dependent on volume. So if you think about it, why would cost be dependent on volume in the long run? Is because we cannot predict if we are going to get 100 patients in 2023 January. Are we going to get 10,000 patients in January 2024? Maybe the business is flourishing and doing better, and maybe we will get more patients in the next year. And then the definition of the variable cost will change a little bit, and that is why even the fixed cost we think is not so fixed, it is also variable. So no costs are fixed throughout an infinite range of volumes. Like if you really have a surge of volume, like during the pandemic, those costs are not called fixed. So the concept of cost classifications must be applied within some relevant range of patient volume. We really have to talk about some time period, and that is why we are referring to relevant range. We have to talk about some time period between which we can define the cost as being fixed or as being variable. So the next item to think about is, why are some examples of fixed and variable costs? What are some examples of fixed and variable costs? Let's say for a hospital's clinical laboratory. So in the clinical laboratory, in the clinical lab, you will have some fixed cost and some variable cost. So let's say you have a lab tech and you are paying them a salary of $60,000 in the year, right? So $60,000 for 2022. Now, it is a set amount, right? At least for 2022. And that is why we say that time period is very important. Even a fixed cost can become variable over a period of time. So if we are talking about that lab tech salary being $60,000 in the year 2022, if that lab gets, let's say, um, 10,000 patients in the whole year, and it does not get, let's say, 500 patients that it got in 2021, it does not matter because the fixed cost of salary for that lab tech is still fixed. You have already set the amount $60,000 for them, and that is going to be fixed. So the lab tech salary is fixed. The variable cost, on the other hand, will be, let's say you have 10,000 patients for 2022 as compared to 500 in 2021. You will be using more tubes. You will be using more tubes. I mean, tubes as in I was thinking about the test tubes, as well as the tube where you draw the blood, and you will be using more syringes. You will be using more cotton and bandage and stuff like that. So those are variable costs that are related to clinical laboratory and are variable because they are definitely dependent on volume. However, the salary of this person, of this lab tech, may also change in next year if the volume keeps rising. They will say that, I'm seeing so many patients now, so please definitely give me an increment, and you will do that. So even their salary is not that fixed, and therefore it is not that much of a fixed cost. So volume impacts both fixed and variable costs to some extent, and that is why we say that we should have a relevant range, a time period between which we are discussing these issues. So this is a cost structure example of a walk-in clinic. The relevant range is a little bit unrealistic in this example, and the variable cost per visit, as you can see, for clinical supplies is $20 and other supplies is 5. So the variable cost rate is $25, and the fixed cost um, per and sorry, the variable cost rate is the variable cost of 1 unit of output. So 1 unit of output, that's what they're talking about. So one patient. The fixed cost per visit is facilities 30,000 rent you're paying salaries $190,000, and you're paying some overhead $80,000 for, let's say, parking lot and so forth. So you have a $300,000 in fixed cost. So if you have a volume of one patient, your fixed cost is not changing. You still have $300,000 in fixed cost, but your variable cost is only $25 for each patient. So your total cost is 300,025, and that is also your average cost. Now, if you have a volume of 100 patients, your fixed cost is still the same, and your variable cost changes because you multiply 25 with 100 to get 2,500, and that gives you, and when you divide, and that gives you a total cost of 302,500, and that you divide by 100 to get 3025 average cost per patient. Okay, so now you understand how to calculate this. Let's look at another one. If so, here average cost per test is calculated as total cost divided by volume. So you take this number, total cost right here, divide it by volume, and get the average cost, which is on the right hand side. I keep losing my mouse. The next one let's look at here, this one. If you get 5,000 patients, then you have a fixed cost still of $300,000, but you have a variable cost of 5,000 multiplied by 25, which gives you 125,000. Total cost becomes 425,000, and then you divide 425,000 by 5,000, you get an average cost of $85. Okay, so what do you see? You see that the average cost is going down. The average cost is going down when you have an increase in volume. So the higher the volume, the lower the average cost. The higher the volume, if you have more patients coming, the average cost per patient is only $37 for 25,000 patients volume. Okay, so we already did this. We have a volume of 5,000 patients. The average cost per visit is 85. But if you have a volume of 10,000 patients, you have an average cost per visit of $55. If you look at this, average cost is $55 for 10,000 patients. Average cost is $85 for 5,000 patients. So the average cost is per patient is going down when you increase the volume. So this is exactly what we just did in the last slide. So we already said that the underlying cost structure is a relationship between total cost and volume, and that it is used by managers for planning, controlling, and decision making. So we also looked at the variable cost rate, and the variable cost rate is variable cost of 1 unit of output. Now this graph gives the managers even a better idea of the underlying cost structure in graphical form. And so this looks at the cost on the y-axis and the volume on the x-axis. So you have a total cost here, you have a fixed cost here, and you have a total variable cost in this line. So the slope of total variable cost line um, is right here, total variable cost, right, in this dotted line. And the relationship between total cost and total variable cost. total cost and total variable cost, you can see that um, total cost line is the slope of the total variable cost line is the variable cost rate, because the line raises at a rate of $10 for each additional test. So the line raises at the rate of $10, so that is the slope. And then the total cost line is total variable cost shifted upward by the amount of fixed cost. So take the total variable cost, and that is shifted upward by the amount of the fixed cost. It's the total variable cost line, and that is basically shifted upward by the amount of the fixed cost. So amount of fixed cost is basically added here in total variable cost, and that is shifted upward. But you can see that the trend is the same. They are both going upward with volume.